Welcome to today's deep dive. So today is August 2026, and we've got a lot to get through.
Yeah, we really do. It is a heavy stack of briefings today.
It is. I mean, tech is booming, obviously, and artificial intelligence is seeing these like $500 billion investments. But then the biggest winner in the stock market today is a 134-year-old soda company.
Right, which is just, it's wild to think about.
Totally wild. So our mission today is to really cut through the noise for you. We want to show you how AI infrastructure, these rapidly shifting global supply chains, government monetary policy, and some really surprising defensive stock rotations are all deeply interconnected.
Because they are. We are looking at a day of just profound contrasts here.
Yeah.
The daily market briefing outlines everything from, unprecedented government debt milestones all the way to private tech consortiums pooling capital on a scale that honestly rivals sovereign nations.
Which is crazy, and that is exactly where we need to start. So NVDA is currently on track for its fourth straight year of outperforming the S&P 500. But the headline dominating investor debates right now isn't just about how fast their chips are. It's this staggering $500 billion AI infrastructure financing partnership.
Have $1 trillion.
Yeah.
I mean, to really understand the gravity of that number, we have to look at the roster of players involved. It's not just tech companies.
Right.
NVIDIA is partnering with BlackRock, Blackstone, KKR, Apollo Global Management, Brookfield, and Goldman Sachs.
Wow. Okay, let's unpack this because those are not venture capital firms.
No, not at all.
I mean, those are the absolute titans of private equity and traditional infrastructure, right?
Precisely. And what's fascinating here is how this specific group of institutions shifts the entire narrative around artificial intelligence.
How so?
Well, up until now, the AI boom has been largely defined by, speculative growth.
Like hoping for the next big app.
Exactly.
Yeah.
It was about throwing cash at R&D, hoping for a software breakthrough. Venture capital looks for that rare exponential return. But firms like Apollo and Brookfield, they specialize in infrastructure.
Right, the boring stuff.
Yeah. They finance toll roads, bridges, power plants, assets that generate steady, reliable, long-term yield.
Okay, so their involvement signals that AI compute is transitioning. It's moving from a speculative tech venture into an institutionalized, almost utility-like asset class.
Spot on. It's becoming a utility.
It sounds like we're moving from, buying a generator for your own house to just plugging into a national grid. And NVIDIA is building the grid and letting Wall Street finance the power lines.
That is a highly accurate way to frame it, honestly.
Yeah.
NVIDIA's strategy here is to securitize AI compute assets.
Securitize them.
Right. In traditional finance, securitization means taking an illiquid asset, bundling its future cash flows, and issuing bonds against it.
Like they do with mortgages.
Exactly like mortgages. But NVIDIA is doing this with physical server racks and GPUs. They are creating a model called inferencing as a service.
Which means instead of a company having to shell out billions of dollars for hardware up front, they just rent the computing power as an operational expense.
Yes. And by securitizing that rental income, NVIDIA can finance further expansion without burning through its own cash reserves.
That's incredibly smart.
It is. It also dramatically diversifies their customer base. Historically, they've relied so heavily on hyperscalers, the massive cloud providers like Amazon, AWS, or Microsoft Azure.
Right, big guys.
Yeah. But now, they can offer top-tier compute to a much wider array of enterprise clients.
And this kind of expansion requires a very physical footprint. The briefing notes that NVIDIA is actively connecting its GPU customers with data center operators in the Nordics.
Right, because you cannot abstract away the physical constraints of AI.
It takes up space.
So much space. You need vast amounts of land, and more importantly, you need continuous cheap power to cool these servers. They run incredibly hot.
And the Nordics have that.
Yeah, they offer a really unique combination of ambient cold temperatures, which naturally reduces cooling costs, and an abundance of renewable energy, like hydro and geothermal power.
So it makes that region a natural geographical anchor for this whole infrastructure boom.
Exactly.
But the software side is accelerating to meet this hardware scale, too. I mean, we have a report from an all-hands meeting at OpenAI where their CFO, Fryer, announced they will be a public company in 2027 or sooner.
Right, an IPO is coming.
Yeah. And on top of that, Stripe is acquiring OpenRouter to deepen its presence in the AI model marketplace.
Which really demonstrates that the distribution networks are solidifying. OpenRouter acts as an aggregator. It lets developers access various AI models through just a single interface.
Okay.
So by acquiring them, Stripe is positioning itself to be the financial rails for the AI economy. just like NVDA is the hardware rails.
But but all of this software, all of these toll roads and financial rails we're talking about, they rely entirely on physical microchips.
Unbelievably.
And right now, the supply chain for that hardware is undergoing a drastic reshuffling.
It really is. The foundation of this entire tech boom relies on a global supply chain that is currently the subject of an intense geopolitical tug of war.
And we're seeing that play out with Google today. The briefing shows Google just agreed to buy up to $12.2 billion in Marvell shares for a custom AI chip partnership.
Right. And this is a very deliberate move by Google to diversify away from NVIDIA.
They don't want all their eggs in one basket.
Exactly. They want to design custom silicon tailored specifically to their own workloads. And that single decision sent Marvell's stock jumping 10% today.
While sending Broadcom shares down, Broadcom has dipped on this news, which kind of extends a pullback that has them sitting roughly 20% below their June highs.
Yeah, they're feeling the pressure.
Because they're losing ground with Google, which is one of their key customers.
Yeah.
Though, I should note, TD Cowen is maintaining a bullish stance on Broadcom, projecting a 27% upside from current levels.
It is basically a high-stakes game of musical chairs.
Yeah.
Tech giants like Google and Meta, they want to own their destiny.
Yeah.
They recognize that being entirely dependent on NVIDIA's pricing power or, their allocation schedules is a massive vulnerability.
Custom silicon is becoming the new competitive moat.
It really is.
And building that moat requires very specialized equipment. Japan's July exports just surged 49.1%. That's a fifth straight month of gains, driven almost entirely by semiconductor equipment shipments.
To understand why Japan is benefiting so heavily from this, you have to look at the mechanics of chip manufacturing.
It's not easy.
No, you can't just build a fabrication plant out of thin air. You need hyper-specialized optical equipment, photoresists, silicon wafer testing machines.
And Japan makes those.
Right. Japanese companies dominate those highly specific niches in the global supply chain. So as the world's appetite for manufacturing capacity expands, Japan basically holds the tools required to build it.
But this isn't just driven by corporate strategy, right? Government policy is forcing the issue here, too.
Oh, absolutely.
The Trump administration has signaled strict opposition to Apple sourcing its memory chips from China. They're heavily favoring domestic manufacturers or allied countries. And the market reacted instantly today. Allied chip makers saw a huge surge. SK Hynix rose 4%, Micron was up 5%, and SanDisk jumped nearly 9%.
Which really highlights how reshoring is no longer just about technological advancement. It is fundamentally about supply chain sovereignty.
Sovereignty meaning control? Sure, but at a huge premium. I mean, if Google is spending billions just to bypass NVIDIA, and governments are forcing Apple to abandon their established cheap suppliers, are we just inflating the cost of everything to play it safe?
Yes, the short-term costs are staggering.
Right.
Ripping up existing optimized supply chains to build redundant, localized capacity is economically inefficient. But governments and megacorporations now view this inefficiency as a necessary insurance policy.
They're willing to pay for it.
Exactly. Relying on a single choke point, whether that's a specific company or a geopolitical rival, is now deemed an unacceptable existential risk.
And that insurance policy creates ripple effects thousands of miles away. Like we're seeing it today in India, which is the world's second largest smartphone market. The rising cost of these memory chips is completely altering their retail dynamics. Chinese smartphone brands operate on razor-thin margins.
Very thin.
So when the cost of memory chips spikes due to these supply chain shifts, those Chinese brands are forced to raise the retail prices.
Right.
And that dramatically improves the value proposition for premium brands like Samsung and Apple, making them far more competitive in the region.
It is a perfect illustration of how a policy decision in Washington regarding memory chips can instantly alter consumer behavior in a retail store in Mumbai.
It's crazy.
The global hardware ecosystem is wound incredibly tight.
Now, all of this global tech, spending the $500 billion financing, the sovereign supply chains, it all requires a stable macroeconomic environment.
Yes, it does.
But the government's own balance sheet is sending some highly conflicting signals to the market today.
We're walking a macroeconomic tightrope right now.
Let's look at the bond market. Wall Street actually opened higher today because Treasury yields pulled back from multi-year highs.
Okay, so why did they pull back?
Well, the catalyst for that pullback was Treasury Secretary Bessent announcing a doubling of the government's debt repurchase program, specifically targeting longer duration securities.
Right. And we need to look at the mechanics of how that actually stabilizes the bond market.
Please do.
When the Treasury buys back its own older, long-term bonds, it introduces artificial demand into the market. Basic economics dictates that higher demand pushes the price of those bonds up.
Right.
And because bond prices and yields move inversely, driving the price up mathematically forces the yield down, so it provides immediate relief to a strained market.
But the context around this intervention is pretty sobering. I mean, CNBC reports that the U.S. national debt just surpassed the $40 trillion mark for the first time in history.
$4 trillion.
It more than doubled in a single decade. And economists are warning that this aggressive buyback move by the Treasury raises serious questions about inflation and the independence of the central bank.
The timing is delicate, to say the least, because we also received the minutes from the Federal Reserve's July 28th and 29th policy meeting today.
And those minutes revealed distinct hawkish undertones.
Very hawkish.
Fed officials are clearly seeing the need for a potential rate hike if inflation fails to cool down. At the same time, President Trump told CNBC that the U.S. should be paying, quote, much less in interest rates, and he publicly criticized Federal Reserve officials.
Right.
Now, we are strictly impartial here, just reporting what's in the briefing, but we have to ask, so what does this all mean? We have the Fed threatening to raise rates to fight inflation, the White House demanding lower rates, and the Treasury pumping money back into the bond market through buybacks. Aren't they driving the same car but stepping on the gas and the brake at the very same time?
This raises an important question about the fundamental structure of our economic policy. You have identified the core tension perfectly.
Thank you.
The central bank has a strict mandate to control inflation, hence their willingness to step on the brake with potential rate hikes. But the Treasury has to manage the reality of a soaring fiscal burden.
That $40 trillion debt.
Exactly. Servicing a $40 trillion debt at high interest rates is economically punishing. I mean, the interest payments alone consume a massive portion of the federal budget.
So the Treasury uses buybacks to step on the gas, easing the upward pressure on yields to keep their own borrowing costs manageable.
Yes, and the market is watching these institutions pull in opposite directions and calculating how long a $40 trillion debt load can be sustained under that kind of internal friction.
And this precarious balancing act is highly vulnerable to external shocks. Which brings us to how these tensions are driving investors into some very unexpected corners of the market as they search for safety.
Geopolitics is currently demanding a premium.
It really is. Oil prices are climbing today due to escalating tensions in the Middle East.
Yeah.
The Trump administration announced Operation Economic Fury, which is an expansion of its economic warfare campaign against Iran. Furthermore, the UAE just severed trade with Iran following a reported missile strike.
Which is huge.
Again, remaining totally neutral on the politics here, but economically, this puts the Strait of Hormuz at serious risk.
The Strait of Hormuz is one of the world's most critical energy choke points. Roughly a fifth of the world's daily oil consumption passes through it.
A fifth?
So any threat to that specific waterway instantly prices risk into global energy markets, which we see reflected in today's climbing oil prices.
We also have trade uncertainties. Tariffs on $20 billion worth of Canadian goods were scheduled to hit, but they were postponed by 3 days.
Just adding to the suspense.
Right. This pervasive atmosphere of unpredictability is leading to some fascinating market behavior. For example, hedge funds like Cantor Fitzgerald are pouring into prediction markets via platforms like Kalshi.
Well, when institutional funds face binary global outcomes, like whether a tariff will hit on Tuesday or Friday, they often turn to prediction markets.
Really?
Yeah, they cannot trade the fundamentals of a stock if the regulatory environment changes overnight. So they hedge their exposure by trading the probabilities of the events themselves.
That makes sense. We're also seeing heightened options activity. Meta options traders are structuring complex jade lizard trades to navigate ongoing legal troubles. And Carvana is under severe pressure amid jitters over a, quote, Mark Walter probe.
A probe involving a high-profile financier often sends ripples through high leverage or heavily shorted stocks. It forces traders to adjust their risk models fast.
Right.
And that jade lizard strategy you mentioned is a perfect reflection of this cautious environment. To execute a jade lizard, a trader typically sells a put option to collect a premium, but simultaneously buys a call spread to protect themselves if the stock spikes unexpectedly.
Wow, okay.
It is a highly technical maneuver designed to box in risk. Philosophically, it tells you that sophisticated investors are playing defense right now.
Okay, here's where it gets really interesting, though. That defensive posture is leading to a massive sector rotation. Investors are looking at geopolitical risks, the macroeconomic tightrope, and potential AI capital expenditure fatigue. And they are pulling money out of overvalued tech and putting it into Coca-Cola.
The ultimate consumer staple.
Exactly. Coca-Cola is up over 25% year to date. In the year 2026, a beverage company is outperforming all of the Magnificent Seven tech stocks.
Which is incredible.
They are backed by a 64-year streak of dividend growth. They just posted 7% revenue growth and 16% earnings per share growth.
Those are solid numbers.
Right.
Yeah.
In a year completely obsessed with AI supercomputers and half-trillion-dollar securitization deals, a 134-year-old soda company is the tortoise beating the silicon hares. It proves that when the world feels unpredictable, investors just want a cold drink and a guaranteed dividend.
If we connect this to the bigger picture, this is a classic flight to safety, but it is happening alongside a targeted infrastructure boom.
How so?
Usually, sector rotation means money flees growth entirely. But right now, capital is bifurcating. It is seeking the reliable dividend of consumer staples because, people buy beverages regardless of what happens in the Strait of Hormuz.
True.
But capital is also flowing into groundbreaking, non-discretionary sectors like healthcare.
Oh yeah, the pharmaceutical wins today really emphasize that point. Moderna and Merck shares soared after releasing late-stage trial data for a combination cancer vaccine.
Which is huge news.
Massive. This therapy significantly extended the time melanoma patients lived without their cancer returning compared to just using Keytruda alone.
A medical breakthrough of that magnitude transcends market cycles. Investors are demonstrating that they will fund transformative leaps, whether that is a cancer vaccine or a $500 billion AI grid, and they will fund the absolute bedrock safety of a company like Coca-Cola.
Right.
But they have zero patience for the speculative middle ground right now.
So to kind of recap the journey of today's deep dive for you, we started with NVDA partnering with Wall Street's biggest titans to engineer a $500 billion securitization of AI compute, basically treating data centers like national power grids. We explored how the demand for custom silicon is forcing a total reshuffling of the global chip supply chain, benefiting specialized manufacturers in Japan while driving up hardware costs worldwide.
And then we examined the macroeconomic reality check as the U.S. government attempts to stabilize bond yields through buybacks while dragging a historic $40 trillion debt anchor, putting the Treasury and the Fed at odds.
Exactly. And finally, we saw how escalating global flashpoints from energy choke points to delayed tariffs are driving a market rotation toward defensive powerhouses like Coca-Cola and groundbreaking healthcare.
As we look at all these pieces on the board today, I want to leave you with a final thought to mull over.
Let's hear it.
We are watching private tech companies and infrastructure consortiums orchestrate half-trillion-dollar computing deals. That is a sum larger than the GDP of many sovereign nations.
Yeah, it is.
Meanwhile, the U.S. government is grappling with the gravity of a $40 trillion debt burden, struggling to align its own fiscal and monetary policies. We have to ask, as we move further into this decade, are the real centers of global economic gravity shifting away from central banks and sovereign treasuries and moving toward the consortiums that control our digital compute?
Man, that is a profound question to end on. If the tectonic plates are shifting beneath our feet, the entities controlling the digital infrastructure might just become the new sovereign powers.
It's entirely possible.
Well, thank you so much for joining us on today's deep dive. It is a complex world out there, but we love unpacking it with you. We warmly invite you back for our next one. Until then, keep questioning the foundation.